Is a recession coming soon?
For the first time in over 30 years, we are seeing these two lines diverge away from each other. It's telling us that something in the financial system is beginning to break. The blue line represents consumer confidence in the stock market, and it's currently sitting at one of the highest levels of the last 30 years, even higher than the readings we had in 2000 that is notoriously known for having been an extremely euphoric period in the stock market. The white line is a survey from the University of Michigan, and it tells us how people are feeling about their own economic outlook, and this one is currently sitting at similar levels to where it was at the heart of the great financial crisis. So on one hand, people feel confident about the performance of the stock market, but on the other hand, they've never been more depressed about their own economic outlook. As you can see from this chart, this is the first time that we've seen such a divergence between these two surveys. This is a symptom of a problem that has extremely deep roots.
Well, where is it in 2020? Where is it in 2008? It's not really I don't see any huge difference.
And as we're going to see, it requires an economic reset before it can be resolved. This is a chart showing us real personal income growth in the US, which is the amount of money people earn after adjusting for inflation. From the 1960s until 2008, real personal income followed a fairly steady trend of about 2.8% growth per year. This long-term trend gave people a sense of what to expect from their future earnings, and so the ability to make financial decisions based on these expectations. This is a concept called permanent income that was developed by Milton Friedman in 1957. As you can see, since 2008,
We look behind. I think it's because of inflation. They just keep printing money.
personal income growth has fallen short of the long-term trajectory. Take someone in 1999, for example. Based on the historical trend, they could have had certain expectations regarding what their income would look like 20 years later. The reality is, for the last decade, the financial expectations that people may have had pre-financial crisis have never been met. Now, what makes this worse is that this gap has recently begun to widen. When we look at the growth trend in personal income from 2010 to 2020, we see that personal income has fallen behind this trend once again since the pandemic. Again, someone in 2015 was expecting a certain level of income by 2025.
I have a theory. I have an insane theory. All the people that got money, $1,000, what was it, 1,200? All of those that got money, they spent it. Where did they spend it? They spent it on businesses. They spent it at Walmart. They spent it on Amazon. And what did the rich people do? They bought more stock. And as they buy more stock and people keep spending on the stock, the shareholders, if you own something, you expect a return. So now that they own more of that company, they expect more back. So where's that more coming from? It's coming from the worker. Probably that's why the workers are being paid less and the company, the shareholders, they're getting paid more.
And is now seeing those expectations come up short. On the flip side, the US stock market has exceeded people's expectations. We can see this by comparing the percentage change of real personal income against the inflation-adjusted return of the S&P 500 since 2010. Real personal income has risen by only about 50%, while the S&P 500 has soared by nearly 300% even after adjusting for inflation. So on one side, people have grown used to being disappointed.
Again, it's all based on debt. Who prints the money? If someone takes a loan out, right? They take a loan out, they buy houses, they flip it, or they rent it back out, right? Who printed money? The people that own the assets, they just keep buying more and more assets. And who pays for it? It's the consumer, the people that work W-2, that work a job. If you don't own anything, you're not going to get paid for anything. If you own the infrastructure, you get paid to use for other people to use the infrastructure.
By their real personal income growth, but on the flip side, stock market returns have blown past most people's expectations. Now, most
Wow.
understand that this gap can't go on forever. The financial economy and asset prices can only diverge away from the real economy for so long.
Well, the stock market doesn't mean the economy, right? The stock market, the stock market is what people perceive it. If more people buy, it goes up more. If less people buy, it goes down. The real economy has nothing in common with the stock market. The stock market doesn't equal the economy.
And this is where the concept of the Great Reset comes in. Some argue that this reset could come through a violent repricing of assets. Others believe it could happen more quietly as income growth somehow catches up to assets. So let's look at how and when this reset is going to happen. Quick reminder, we're celebrating our 5th birthday at Bravos Research, and we are offering losing trades. You can check the offer.
You know, I am actually looking at the stocks. I'm like, all right, when is it gonna drop? I want to put in money when it drops, but at the same time, I'm also buying like what's it called? Dollar cost averaging. You just spend the same amount every week, every month, and if it goes up, you buy less shares. If it goes down, you buy more shares. But I want it to go down so I can lump sum everything into it, and then it'll grow.
In the United States. Since the 1980s, it has been trending lower, falling
Wow.
from around 13% to just 4% today.
It's crazy. I did not know people don't save that much. People just spend everything, every last dollar. One part of me is like, wow, that's so freeing. You get to just spend whatever you want. But the other part's like, damn, that's really dumb. That's really stupid. Why would you do that? You're gonna work till the old people that keep working? Yeah, it's gonna be dumb.
Now, look at what happens when we add corporate profit margins on top. While the savings of the average American has been declining, corporate profit margins have been steadily.
That's what I'm saying. The more people that invest, they expect more profit back. They expect more yield on their money. That's why the corporate margin has to increase. Because you have so many shareholders expecting a return. What happens if you don't reach those? Then your stock plummets. The investors pull their money out. So you have to keep increasing your margins while paying. So someone has to lose. It's like, I forgot the term. It's like someone wins, someone loses. It's not like everyone wins. It just doesn't work like that.
Climbing. This
I think it's called the zero-sum game.
divergence is extremely important to understand. Corporate profits ultimately get distributed to shareholders, and unlike wage earners, shareholders don't spend most of the income that they receive. Instead, much of it gets reinvested back into.
See, that's what I'm saying. It's like a positive reinforcement loop. The more money you invest, the more money you get, and the more money you can invest again, and the more money you get from that more investment. I butchered that.
To financial assets like stocks, gold, Bitcoin, private equity, or real estate. And we can see the results of this all around us. Home prices are at record highs. Gold has been hitting new all-time highs.
I keep waiting for the right moment. It's probably not the best idea, but even like housing prices, insanely high. I'm not gonna buy now. Stock prices, insanely high. You look at some of the companies' PE ratio, it's insane.
Bitcoin is also trading at all-time highs and being adopted as a new financial asset. And all of this has been fueled by a backdrop of record corporate profitability.
It seems too good to be true. Like, I look everywhere. I'm like, why is everything too good? It makes me skeptical. If something is too good to be true, it probably is.
Inherently, there's nothing wrong with this process. It's a natural extension
my
of
light.
how the financial system works. The real problem begins when this dynamic filters through to housing. Throughout most of the last 60 years, the average price of a home has been roughly 4 times the yearly household income in the United States. Since the late 1990s, however, that ratio has moved to roughly 7, essentially making housing about 2 times less affordable. Now, keep in mind, shelter is the largest component of the consumer price index, so this has a disproportionately large impact on people's budgets. If a larger and larger share of someone's income goes through to shelter, that naturally leaves less room for saving, and so pretty much nothing left to invest in assets like stocks, gold, Bitcoin, that have been compounding wealth for those who can afford them. So in practice,
Did you know your house is actually not an asset? An asset is something that puts money in your pocket. A house takes money out. You have lawn care, you have property taxes, you have maintenance, you have water, whatever you do. It's an expense. It's the same as an apartment. What is an asset is if you buy a rental unit. Let's say you buy a fourplex, you live in one and you rent out the other 3. It could be an asset depending on if it gives you more money or it takes more money from you. It could be less of a liability if it takes less money from you. But all in all, if it takes money from you, It's not an asset.
In practical terms, it means that many households remain stuck exactly where they are throughout their life. Their expenses rise, but their ability to build wealth through asset ownership doesn't keep pace. And we can see the impact of this on how people feel about their future. Back in 2000, roughly 75% of Americans said they had a good chance of improving their standard of living. By 2010, that had dropped to 50%, and today that number has fallen to 25%. That's a staggering shift in just a period of 25 years. And this has all translated into the highest level of wealth inequality in the US since the 1920s. This chart shows us the share of wealth owned by the top 0.
You know what that is? That's called compound interest. It's way more easier to make money if you have money. It's a positive reinforcement loop, and you can't stop it. It's like the snowball effect. If you make 10% compounded, dude, it's an insane amount of money. But it's the same people that invest that have all the money. It's the same people that don't invest that don't have any money. See the pattern?
0.1% of the US population. This is the quote-unquote reset that many people are looking for, that somehow we see wealth inequalities come back to where they were in the 1960s. Something similar to what happened during this period right here, where the wealth inequalities of the early 1900s were completely reversed and led to one of the most prosperous.
That's not going to happen. Unless there's a huge, law that comes out, legislation that comes out that changes everything. It's not going to happen because the people, if you look at, lottery winners, they go broke. If you look at big sports athletes, they go broke. Why? Because if you split all the money in the world evenly across everyone, the same people are going to be on the top and the same people are going to be on the bottom. You know why? It's their spending habits. It's what they do with the money. If everyone had 100,000, right? How many of them? Some people will go buy a car. Some people will buy a G-Wagon, Corvette, I don't know, Lambo, McLaren. Assuming they're not even that cheap, but most people will spend all their money on those. And what are the other people buying? They're buying houses. They're taking loans out. They're buying businesses. They're buying stocks. And then eventually, it all evens out. Because let's say someone bought shares of the bank, right? Bunch of shares of the bank. The people that bought shares of the bank, they get money from the people that bought the car and took out a loan. If the people buy Ford stock, they get money from the people that bought $100,000 trucks. So it all evens out. It's who wants gratification right now, who wants to be happy right now, spend everything, who wants to invest for later, and have more money later.
Periods in US history with a thriving middle class. If we put the S&P 500 index on top of this chart, we actually see that the peak in wealth inequality in 1929 coincided perfectly with the top of the stock market. Back then, rising asset prices, particularly stocks and housing, were also contributing to high levels of wealth inequality. The market crashed.
Alright, this makes no sense. Look, this whole blue line is declining. Why is the white line increasing? This has no correlation.
Crash that followed between 1929 and 1940 coincided with the beginning of a reversal in this wealth inequality trend, as you can see from this line moving lower. But this shift didn't just randomly happen on its own. A catalyst was needed, a trigger that forced what many would call the big economic reset. To understand what that trigger was, we can replace the S&P 500 with the top marginal US corporate income tax rate. In the 1910s, the top marginal
50%?
tax rate on corporations was 0%. Policymakers then
50% is insane. Look at that.
Proceeded to push it to nearly 40% over the next few decades.
40 is still a lot.
Now, although there are many theories around what actually caused the Great Depression and the crash of the 1930s, it's likely that this rise in corporate taxes was one of the key forces that triggered it. This was economically painful. It squeezed corporate profits, it dragged asset prices lower, and it caused unemployment to rise. But it did help flip the wealth inequality trend that had been climbing in the decades before. And these high levels of corporate taxes did coincide with an extensive period of low wealth inequality in the US. In the 1980s, however, we saw the corporate tax rate come down. At the time, US corporations were under real strain. Profit margins were squeezed, and the economy was struggling in the early 80s as a result of high inflation and weak growth. Policymakers responded by cutting taxes in order to relieve pressure on businesses and get the economy booming again. And it worked. The economy accelerated through the late 1980s and 1990s, with strong growth and large appreciations in asset prices.
Even all right. What are these charts? You're just throwing charts together. Look at this. The white line, you said it should decrease because of the hike in tax rate, corporate tax rate. But the white line just steadily keeps going up. These charts make no sense. And then you're like, "Oh, when it decreases, the stock goes up." Well, yeah, when it increases, the stock also goes up.
Between 1982 and 1999, the S&P 500 index delivered nearly a 20% annual return. Behind the scenes, however, these policies did set the stage for wealth inequalities to reverse and begin moving steadily higher over the following decades. Today, as the corporate tax rate has fallen to the lowest level since the 1930s, wealth inequalities have risen to the highest levels since the 1930s.
Oh my god.
Since the 1930s.
All right, look at this. The earliest point where it dropped is here. Fucking, I don't know, 2020, right? And the wealth inequality crossed it around what is this? 2008, 2010? The wealth inequality went higher before the tax rate was cut. What is this?
1930.
What? It's using random data points. This all makes no sense.
Wealth inequalities have risen to the highest levels since the 1930s. Now, wealth inequality in the US has multiple factors influencing it. There is not just one clear explanation for why it has happened, but this chart does likely explain part of the story. Lower corporate taxes have allowed profit margins to stay very resilient, even while the US consumer has been under pressure. We happen to think that this great reset will come when this line finally reverses and starts moving higher. This will probably cause a lot of pain and cause asset prices to drop violently like they did in the 1930s. So what does this all mean for the US stock market today? Well, the stock market discounts future events. So it's possible that the stock market could peak before corporate taxes actually begin to rise. This is what happened in 1929. The peak in the market occurred a year or two before.
How? Let's go back. Look. It says the stock is going to go down by that much while this increases by that much. How in 1940, 1945, this hiked. What is that? That's like, it hiked almost 20, 30%. And then another 10%. How come in that point, it just keeps going up? This will bring us back to pre-COVID days. Or is this COVID? This is probably COVID. Oh no, that's not COVID. Let's go in the middle. Yeah, pre-COVID days. This is COVID.
This is what happened in 1929. The
How?
peak in the market occurred a year or two before corporate taxes were raised.
Okay. A little bit of correlation, causation, whatever it is. A little bit of cause and effect. But how come when it goes this much higher that this is still down here?
Starting in 1931. For now, however, we remain long on assets that stand to benefit from today's macroeconomic backdrop that includes stocks, that includes gold, and that includes crypto. These are assets that are experiencing extreme inflows as money is flooding into financial markets. But there will come a moment when this trend flips in the opposite direction, and that's when things could get ugly. Our strategy will flip to a much to celebrate our five.
This is all speculation. What is this, a course? Yeah. This makes no sense. Maybe to Joe Schmo who knows nothing about finance. But this, look at it. The stock's been going up all the time. I think if there's no major event like COVID, that was a huge event. It's like, oh, everything's closing down. That's a big event. That's when everyone's like, oh, if everything's closed, lockdown, people can't go out, they can't spend, economy's gonna crash. Then everyone starts selling. But look at us now. What's coming our way? What is coming our way that's gonna scare everyone to selling, which will plummet the stock? What's coming? Unless a black swan event comes, which is COVID. COVID was like probably once in a lifetime black swan event. Like no one believed it. No one believed that would happen. A virus going worldwide, locking every country down. No one thought of it, but it happened. So I think stocks will keep going up. Like there will be certain small pullbacks, but long term it'll keep going up. For me, I'm thinking of throwing all my money into stocks, right? I do keep a chunk of cash just in case it does flip, and then I just invest even more. But currently I just invest small amounts every week, and if it keeps going up, I'm in it. The worst part is if you take everything out, wait for the crash, and it never crashes, you just wasted time. You just wasted gains. You could have gained what, like 10%. There's a thing. It was like if you missed the 10 best trading days, you would have lost like what? Fucking 17%, 20%. So it's better, was Warren Buffett's quote. Warren Buffett, Charlie Munger? It's one of them. It's like time in the market is better than timing the market. Because who can time the market perfectly? No one. Best thing, just keep investing. And if it goes down, invest more. If it goes up, invest less. I just invest the same amount. If it goes down, I invest more. If it goes down more, I invest even more. That's how I do it. And then eventually, I'll start to take it out. I'll take a loan against it because if you take it out, capital gains. If you sell it, capital gains 30%. But if you take a loan against it, 7%, 8%, much lower than 30% because it's a loan. It's not taxable. Use that, buy a business. Business makes, I don't know, 30% if you're good. And then just keep doing that. It's infinite money. That's all for this video. Once in a lifetime economic reset is coming? I don't think so.